In the 1600s, the Dutch East India Company sent hundreds of ships across the globe, trading gold, porcelain, spices, and silks. But here's the catch. Running these massive voyages wasn't cheap. So how did they fund it? By selling shares of their company to everyday people. And in the process, they unknowingly created the world's first stock market. Here's how it worked. Citizens could invest money to help fund the voyages. In return, they received a share of the profits when the ships returned. The more successful the journey, the more money investors made. This system allowed the company to grow larger and wealthier, while ordinary investors gained a chance to profit from global trade. That simple idea, pooling money from investors in exchange for ownership, became the foundation of the stock market. Mokro fast forward 400 years, and the stock market has evolved into a massive global network with billions of trades happening daily. But at its core, it still works on the same principle. Companies raise money by selling ownership shares, and investors buy those shares hoping the company will succeed. Let's say a brand new coffee company wants to expand. To raise money, they go public with something called an IPO, an initial public offering. Big investors get the first chance to buy in, and once it launches, anyone can purchase stocks. Buying a stock, you're essentially becoming a partial owner of that company. If the company grows and profits, the value of your stock usually increases. But if the company struggles, the stock price can fall, meaning investors could lose money. So why do stock prices go up and down? It's mostly supply and demand. When lots of people want to buy a stock, the price rises. When many people sell, the price falls. But demand isn't random. It's influenced by everything from company profits, leadership changes, and new laws, to world events, and even investor confidence. Yes, human emotion plays a huge role in the stock market. Fear and excitement can spark massive booms or sudden crashes. That's why many experts suggest focusing on long-term investing rather than chasing quick profits. Over time, good companies tend to grow, and patient investors usually benefit the most. Today, you don't need to be a wealthy trader in a crowded exchange. With just a smartphone, anyone can buy stocks, support businesses they believe in, and start building wealth. The stock market may look complicated, but at its heart, it's still the same system the Dutch East India Company created centuries ago, giving people the chance to own a piece of a bigger journey. So, how does the stock market work? It's simply a marketplace where ideas, businesses, and investors meet. Whether you're trading spices in the 1600s or tech stocks today, the principle is the same. Invest in growth, share in success, and take part in the story of global progress. If you found this video helpful, don't forget to like, subscribe, and join us for more breakdowns on money, business, and investing.